All right, beautiful people. Thank you so much for joining in today. My name is Tony George. If you're just getting to meet me for the first time, I'm a trader, I'm an analyst, I'm also an educator. All right, yeah. And I know very well that I basically could have just one or two things to add to your trading knowledge that could be a game changer for you. Today, we're going to be looking at the secret scaling strategies, all right, and how we can also build an ultimate price action playbook, okay? So think of a playbook like a step-by-step guide that can enhance your understanding of your own rules and regulations in trading. Okay, that's basically a playbook. Okay, so we're going to see how we can learn one or two strategies. It might not be your own go-to strategy, but the concepts you can play around with, and also the ideas or the building blocks of the concepts that I want to share with you today in this video, you can also inculcate or incorporate into your own trading system or your own trading concept, and then give more refinement and precision entries, increase profitability in your own trading systems. All right. So without any further ado, let's quickly go ahead. I've said this before, but let me say it again that there are plenty confusions because of the scattered informations that we can find in the trading space today. Everybody out there is a mentor. I'm not saying it's bad. At least it helps us to achieve a lot of good results with lesser amounts to be paid because a lot of informations are out there. But you know what this can make you do? It can make it very difficult for one to stick to one strategy. And if one cannot stick to a particular strategy or a concept of trading, then it can basically cause inconsistency in the trading results. Okay. But what I want to share with you today is a very simple strategy. Okay, very simple strategy. It is very mechanical and also easy to repeat. Now, let's quickly look at it. Okay, I've broken the building blocks into four. All right. For those of you that attended the GoPro the forex mentorship cohort, I shared three. Now I've broken it into four so that we would be able to have a seamless flow based on my own personal trading style and strategy. All right. So the first thing you would want to be looking out for is the market structure and order flow. Okay, the market structure and order flow. Basically, when we talk about market structure, is you being able to identify the major highs and major lows. Okay, being able to identify major highs and major lows. Okay, and another is for you to be able to differentiate a bullish market from a bearish market. All right, the order flow simply talks about the bullish order flow or the bearish order flow, being able to identify that okay, there are consistent higher highs and higher lows, which is a bullish order flow, and a consistent what lower highs and lower lows, which is more or less like the bearish order flow. Okay, so once you're able to understand the market structure and the order flow in the market, you should score yourself say 20%. Okay, you should score yourself 20% because that's the first step. Now, once we're able to do that on the higher time frame, we will also go ahead to find the liquidity concepts. Okay, liquidity concepts. We know that liquidity fuels every market move. Liquidity is the driver or the driving force to to the momentum that we see in the market. And so, where liquidity is absent, the market will be silent. That's where we see choppy market or consolidating market. You get right. So should be able to find liquidity. Where are the market makers putting their positions? Is it at this point? Are they putting their money to push the market upward, or are they putting their money to push the market downward? All right. We need to have an idea around the liquidity that fuels the market. Okay. So it is our duty to find that liquidity area so we would not be the liquidity needed for the market to make its next move. Okay. Um, the next thing we need to find is the point of interest. The point of interest. Now, think of point of interest as think of point of interest as someone. Think of point of interest as a pilot who is flying from Lagos, Nigeria to, let's say, Australia, okay, and has to make two stops before Australia, okay. Now, those two stops he has to make is the point of interest, because our interest is, if he takes off from Nigeria, where is he going to land next? If he takes off from where he's going to land next, where else is he going to land? Let's assume that we're going to Australia with let's assume we're going to Australia with um say Qatar Airways, right? If we take off from Lagos, Nigeria, with Qatar Airways, we know for sure, for certain, we know our first stop is in Doha, right? Now, from Doha, probably we take a next stop, and then I don't know, maybe I don't know. Let's just say from Doha we take our next stop to mm, say Germany, okay, and then from Germany we fly all the way down to Australia. I don't really know, but I'm just making an instance. So our point of interest will be where we have to stop next, Doha, then next Germany, right? Now, if you don't know where we're going to stop next, you probably may not be able to properly time your travel. Okay, let me know in the comment section if it is true. Okay, if it is true, just type in the comment section very true. If you don't know your next stop and how many hours it will take you, you probably may not be able to time your travels. You probably may not be able to also time your meals. You probably will just be on that flight, and then you might be missing some certain opportunities. You might also be missing the opportunity to take beautiful pictures when you get to Doha, because Doha is very beautiful. Their international airport also is one of the most beautiful, right? Now, you get to miss all of these chances and all of these opportunities because you don't know the point of interest. So, point of interest are significant areas, reference points, areas in the market where we get to uh, be sure of the next move of the market. Market comes to those areas for us to be sure that the market is doing this next move. So market comes to Germany so that it can take off now to Australia, right? So that's point of interest. And in when it comes to forex, one of the ways that we can find these points of interest, number one, is through the use of the order block. All right. So basic SMC concepts, the order block. I believe every one of us know the order block, because in practical today, I'm not going to be teaching you order block or anything I'm going to be mentioning. I'll only basically be using them and probably be giving a little explanation on the concepts here. All right. So order blocks, number one. Number two, imbalances. All right. Now, when we talk about imbalances, we'll probably be talking about the fair value gap or the liquidity voids. Okay. The fair value gaps, the liquidity voids, or even inverse fair value gaps. Okay. I know a lot of people do not know that inverse fair value gaps also exist. Okay. So, yeah. So these could also be points of interest. Next, we're going to be looking at the breaker block and the mitigation block. All right, the breaker block and the mitigation block. The breaker blocks also serves as very important points of interest. So you get to go find about them. Then mitigation block also. Okay, when another flow is being mitigated, the block which serves as that mitigation blocks also becomes a reference point in the future. Mitigation blocks most times can be used in continuation patterns, as I will show you when we continue this tutorial today. Okay, then the last but not the least is Quasimodo levels. Okay, Quasimodo levels. Now, it's also good that you find out about Quasimodo levels. Now, these that I have mentioned are not everything. Okay, you can also go back and study how you can find points of interest and how you can use them. All right, like one of them that I frequently use that is not mentioned here is the Fibonacci retracement levels as well, the Fibonacci retracement tool. All right, for us to find the depth of retracement, and most times I also apply that when as a way of double confirming if an area I've chosen is a point of interest. Okay, but I haven't mentioned it here. Okay, probably skip my mind, or probably I did not want to mention it. I don't know. Okay, so these are points of interest. So knowing where market comes to, and from that point, you know very well that market is going to also make the next decisive move, is going to be a plus for you. If you're following me, please can you type in the comment section follow? All right, type in the comment section follow if you're following me before I share the last one with you. Okay, type in the comment section follow before I share the last one with you. All right, amazing. All right, amazing. Okay, so the last but not the least we will be talking about is the extra confluence techniques that we're going to be using. Okay, the last time I shared this, I did not share this fourth one, and it was a bit of a problem for me because I was trying to share with you some person's model of trading. Okay, but when I find out that it wasn't just working for me. All right, I had to go make the refinement, and I had to add this last one, which is the extra confluence techniques. For those of you that know me for many years, I always say that um, without 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 confluence, okay, without confirmation, there should not be any trade entry. All right. So one of the last things that you will resort to in order to take any trade is the fact that there should be a trade confirmation. Okay. So without a trade confirmation, there should not be a trade entry. Okay. There should not be any trade entry. And it's very important. Most people do not know that this is really important. Without a trade confirmation, there should not be a trade entry. Why? Because most times everything looks really, really, really okay. Can everyone confirm that you can hear me? I think King Nemi FX is saying that my mic is not clear. All right. Can everyone confirm that you can hear me loud and clear once more in the comment section? Okay. Before I continue, so that I'll be able to carry everybody along. All right. Okay. Amazing. Amazing. Okay, so yeah, without confirmations, most times we can make very bad decisions with very good intentions. By that, I have been burnt a couple of times simply because I saw a very perfect trade setup, but there was no confirmation yet, and I jumped in, and at the end of the day, I got my fingers burnt. Okay, so you might want to apply some confirmation techniques that probably works for you. All right. There is the volume print. All right. There is the volume footprint. I'm yet to fully understand the volume footprint. It's not difficult to use, but I think before you first have to assess it, there are certain level of subscriptions and upgrades to your trading view account that you need to make. And yeah, I'm on paid version, but I think I need to still upgrade to a higher package for me to be able to use a footprint. Okay. And secondly, you can also use momentum indicators. So these ones you do not need any subscription to access them. Okay, like the relative strength index, the MACD, the CCI, anyone that basically works for you, or even the stochastics. Okay, anyone that basically works for you. For sake of educational purpose and how I trade, sometimes I'm going to be using more of the commodity channel index in this video. You can also use price action. All right, price action confirmation patterns, maybe the bullish engulfing, bearish engulfing, the arami, the shooting star, and so much more like that. You can use all of these to confirm if prices are at a point of interest. Okay, if prices are at a point of interest, let's take confirmation like this. Okay, I've already started making some instances with flight. Okay, that a flight gets to a particular point of interest. How would you know if it is going? How would you know the next decisive decision it is taking? Now let's assume that a flight flew all the way from Abuja to Lagos. So this is Lagos. So Lagos becomes our point of interest. Now, to the south of Lagos, to the south of Lagos, we have Port Harcourt. Okay, to the south of Lagos, we have Port Harcourt, and to the west of Lagos, we have, let's say, Ghana. Okay, to the west of Lagos, we have Ghana. So this is Ghana, and this is Port Harcourt to the south of Lagos. Now just watch my analysis, okay? And okay, and where else again? Where else again? Where else again? Let's say that to the north of Lagos we have Ibadan, okay? Ibadan. Let's say we have Ibadan to the north of Lagos. Now, the point of interest is Lagos. But how do we know that from Lagos we have the next move to Ibadan, we have the next move to Port Harcourt, or we have the next move to Ghana? All right. So one task we have is finding where is the next point of interest. Once we get our next point of interest, our duty as profitable forex traders or intending forex profitable forex traders is not over. The next step will be for us to determine where next our movement is going into. Is it Ghana? Is it Port Harcourt? Or is it Ibadan? All right. And the only thing that can let us know the next large movement to the next destination will be the extra confluences that we apply. So let's assume that if our flight should make a turn and position to take flight looking towards the north of Lagos, we know that okay, that flight is going to Ibadan. All right. If the aircraft should make a turn and look as though it is flying towards the south of Lagos, then we know that it is going to where? Port Harcourt. And then if it makes a turn and looks as though it's flying to the west of Lagos, then we know that it's going where? Ghana, right? Exactly. Sorry, I have to keep this away. All right, so it's flying to where? Ghana. Now, confluences at those points of interest, okay? Confluences at those points of interest is what will help us to be able to make the right decision as to where market is going next, okay? So that's going to be the last phase before we enter our trade. Every other thing is going to be trade management and much more like that. So if you get these 4 points, let me quickly go over to the step-by-step framework, okay? uh I've also reduced this step-by-step framework to about only a 4. All right. So on the 4 hourly time frame, we will be able to identify the overall bias and locate major points of interest. Remember, I've mentioned what are the points of interest: order block, fair value gaps or inverse fair value gaps, or liquidity void. Then what? Mitigation and mitigation blocks, or what else again? Breaker blocks, Quasimodo levels. What else again? I also mentioned the Fibonacci retracement levels. Yeah, all of these you can find them on the 4 hourly time frame. So 4 hourly time frame will be significant for two major things. Listen carefully. The 4 hourly time frame will be significant for two major things. Number one, for us to identify the market structure and price order flow. Okay, the market structure and the price order flow. Then number two, that the 4 hourly time frame will help us to make to help us to decide will be the points of interest. Okay, it would be the points of interest. Well, whilst we are able to do these two on the 4 hourly time frame, then our next action will come. Okay, number two will be when prices enters these points of interest. Okay, because now we've known the order flow on the 4 hourly time frame, we've known the structure of the market. We're waiting for prices to come into the points of interest still found on the 4 hourly time frame. So eventually when prices come into that 4 hourly point of interest, the next thing we will want to do is we will want to drop down to the 1 hour or the 15 minutes time frame. Okay, now the essence is, oh, okay, that price has come into our area of consideration, our reference zone. It will be nice that we scale down to a lower time frame so that we can find how prices react on the lower time frame and have an early entry into the market. Okay, because early signs of confirmations will be key for us to maximize the impulsive move that happens or takes off at that point. Making sense here? So we will scale down to the 1 hourly time frame or the 15 minutes time frame, all right? And we will then find early entry and confirmations on that zone, okay? Now, number three is we will wait for price to confirm using extra confluence techniques, which is what I've just mentioned, okay? The extra confluence techniques, like I said, in this case, I would be using the commodity channel index. And by the way, guys, I also found out a way to, make some confluences. It's good you always learn some new things, by the way. All right. So I've apparently been seeing these. Maybe I'll share that with you in another video. Okay. So number four is you enter your trades only after confirmations come. Okay. Enter your trade only afterwards confirmations. Enter your trade only after confirmations. Now let's quickly look at two basic things that the market does, and I'm going to be sharing with you some models that we can use to trade them. Okay, two basic things that the market does and models that we can use to trade them. Now, what are the two basic things that the market does and how can we profit from them? Number one, if the market is not making a reversal, then number two, the market will be making what? Who can let me know in the comment section? Who can let me know? If the market is not making a reversal, then it is making what? Let me see, 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 let me see who is getting it. Okay, if the market is not making a reversal, then the market will definitely be making one more thing. I don't think there are more than these two things. Yeah, everybody is saying continuation, and of course, it is continuation. So if the market is not making reversals, the market is making continuation. So you need to know this, okay? There are only two things that the market does, okay? The market is either making a continuation move or is making a reversal move. Now, you need to understand and study these models or these patterns so that when they play out, you will be able to identify them. You will be able to say, oh, okay, look, this market is about to make reversals, okay? Or this market is about to make continuation, okay? That makes sense, yes? That makes sense, yes? All right. I think yeah, everybody is just following. All of you are saying continuation in the comment section. All right, that's a thumbs up for you. All right. What of consolidation move? Yes, consolidation, yes. But consolidation is still part of either a market is making a reversal or is making a continuation. Uh, Consolidation is just in between, but it's not something that we usually trade. Okay, it's not something we usually trade. So when consolidation happens, you will see it. Most times it happens either in the reversal phase. Okay, the reversal model is a whole phase. Okay, it's a whole phase. It's not just one time reversal. No, it's a whole phase. And then of course the continuation as well is a whole phase that can also carry consolidation as part of it. All right, so let's quickly go ahead now. So the reversal model that I'm going to be sharing with you is the ICT concept, which also we've built some other amazing concepts around it. For those of you that have been following me for years, we've built the ICC concept. And what is the ICC concept? All right, for those of you that know, ICC is an acronym for impulsive, all right, corrective, and continuation. Okay, impulsive, corrective, and continuation. Okay, continuation. These are the concepts that we would be applying. Okay, basically. So this is an ICT concept. It is an ICT concept, but built to suit the ego of just retail traders. Okay, people who are not fully smart money traders. Okay, so basically impulsive, corrective, and continuations. These are the three building blocks of the reversal model. Impulsive, corrective, and continuation. So if you will give me your time, I'll quickly explain this and then we will go over to the chart and see how we can find it. Okay. So now watch closely. So we have three building blocks to build the reversal model, right? The first is what? The impulsive. Now, the impulsive should be a large market movement. Okay. The impulsive should be a large market movement. Okay. The impulsive should be a large market movement. Sorry. A large market movement that should be able to take out. Look at, there is liquidity here. Remember, for those of you that have attended my liquidity classes, I said that liquidity most times rests above swing highs and below swing lows. Okay, so major swing highs, major swing lows, Even though they are not major, there might be minor swing highs and swing lows. Liquidity rests above and beneath them. All right. So this is a swing high before, and so we have a lot of people's stop losses that must have been placed around this zone here. All right. So the impulsive move should be that move that is capable to clear out the liquidity that we find here. Okay, the liquidity that we find here, the impulsive move should be able to clear out that liquidity. So that impulsive move, number one, please write down, the impulsive move should be capable to cause a liquidity purge, or what some people call the liquidity sweep. If the impulsive move does not cause a liquidity move, then it is not so good to be considered an impulsive move. Okay, now after that liquidity sweep, we now have a new high that is being created. All right, and then market now makes a corrective move. Remember, this is most likely a bullish move. Okay, a bullish move where we are having higher highs, higher lows, higher highs, higher lows, and then finally at some point where the buyers become weak, we have one last push to cause a liquidity purge or a liquidity sweep, and then creating a new high, all right, with some liquidity resting on it. But then apparently the market makes a more significant move now, which is a corrective move. Now this corrective move, okay, this corrective move is also very important. I'm explaining every one of them and how you can validate them. So listen carefully. Number one, I said that the impulsive move should be able to cause a purge in liquidity. Now, the corrective move should be able to change the dynamics of that trend. Okay. Remember, the trend has been making higher highs, higher lows, higher highs, higher lows. Okay. Now, the corrective move should be able to break structure or cause a major shift in market structure. All right. The market structure we know is the bullish order flow in this case. Yeah. All right. The bullish order flow in this case. But sorry. Okay. Yeah. What we want to see is that the corrective move should be able to change to cause a major market shift. Okay, market structure shift. Okay, so once that is done, that's what people call MSS, which is a market structure shift, or we call it the change of character. Okay, Mr. Greg, please stop writing on my screen. Okay, Mr. Greg, please stop writing on my screen. Okay, now after that, um then we have this move now back into the point of interest. So this point of interest is where we want to oh, sorry, I think I have made a little mistake. Sorry, let me come back. All right, I think I have made a little mistake. Pardon me, pardon me, pardon me, pardon me, pardon me, pardon me, pardon me. The impulsive move, okay, the impulsive move should be the one that causes the shift in market structure, all right, not the one that purges liquidity. So the impulsive move should be strong enough to cause a shift in market structure. Okay, the impulsive move itself should be the one that is responsible to cause the shift in market structure. Okay, so yeah, was supposed to be respected at least equal high or a little above it for continuation to happen. But then the impulsive move shifts that market structure and causes a change of character. Then we have the corrective move. Now the corrective move is what drives prices into our point of interest. Okay, the corrective move is what drives prices into our point of interest. And then when prices comes into this point of interest, this is where we now find what to do. Okay, this is where we now find the confirmations that we need for the next market move. Now we know that the market is going to go down simply because there had been what a significant market structure shift. All right, and prices now is driving to the point of interest, giving us another opportunity to tag along in the shifted structure of that order flow. Okay, if it's making sense, please let me know it's making sense. I'll share with you the second model and then we will go over to practice. Okay, we'll go over to practice. All right, just let me know if it's making sense. Let me share the second structure with you guys. Okay, if it's making sense, just simply let me know it's making sense so that I can share the second structure with you guys. Okay, Oh, Mr. Tolulope, you're welcome. Someone is asking that I repeat, okay? So let me repeat that again, just very quickly. I said that there must have been a liquidity purge, all right? Now, after that liquidity purge, we know, okay, look at it. A bullish movement is higher highs, higher lows, all right, creating another higher highs. Sometimes it can come back to create an equal low, but the structure has not been changed, okay? So long it is an equal low, the structure has not been changed. It is still a bullish movement, and prices can go back up again, all right, creating another lower low. So prices can move like this, okay? So prices can even move like this. What if prices does this? Would you say that prices, the structure has changed? Of course not. So long as the liquidity on this zone here, so long as that the structure has not changed, okay, on this zone, we are still in a bullish movement, and then prices can go back up. Okay, now let's look at this here. Now, so long as market keeps moving in this direction, the price order flow is bullish. All right, and then where we would now have is an impulsive move that now breaks below this point here. You see this point here? An impulsive move that breaks below this point here, thereby causing what? Thereby causing the change of character, okay? Thereby causing the change of character or significant market shift, okay? The shift in market structure, all right? Now, once that happens, we want to find then a corrective move to bring us into our point of interest. This is where we now find confirmation and then tag along. So the first move, which is this, should cause what? A market structure shift. The corrective move should be able to drive prices into our point of interest, thereby giving us another opportunity to tag along the market. And then our continuation from that point of interest is our opportunity to tag along the market and take some safe trades. Okay, so the impulsive, the corrective, and then the continuation. Okay, the impulsive, the corrective, and then the continuation. All right, so that's for the reversal model. Okay, that's for the reversal model. Let's quickly go and look at the continuation model. For the continuation model, what you just basically need to understand is the break of structures, the order flow of the market, and then we would be able to then find the points of interest, still using the same things that I have mentioned: order block, mitigation block, breaker block, fair value gap or imbalances, Fibonacci retracement levels, and also the Quasimodo levels. Okay, now for the continuation model, let's say in this case we're considering bullish. Market is going up, coming back, creating a higher low, go back again, create a higher high, it comes back again, create a lower low. Okay, so this point of interest, the point of interest where market comes back, because market retraces back, we know that the next move is bullish. Because why? Price is in a bullish order flow. Okay, the structure of the market is a bullish order flow. So when prices retraces back, have a bearish retracement into the point of interest, that is our decisive zone. That is where we are now going to decide to tag along for the next bullish movement. But before we do that, confirmations. Okay, so I believe this is also understood. Okay, if this is understood, then I'll possibly stop sharing my screen here. All right, I'll then go over to the charts where I would be able to share my charts, okay, so that we can make some practicals. Okay, so just pardon me, let me quickly just get to my chart and we can share that now. All right, amazing. So we are here now on my chart. Okay, we're now on my chart. Okay, so the first I will be demonstrating for you guys, okay, the first I will be demonstrating for you guys is the reversal model before the continuation model. Okay, the reversal model before the continuation model. All right, so how do I do this now? the other time it was difficult for me to. Okay, sorry, just give me a second. Okay, good. All right. Sorry. I'm trying to see how I can have all of these without disrupting anything. Okay, I think that's the farthest it can go then. All right. So, on the right hand side of the screen, if you can see my screen, on the right hand side of the screen, oh, I think it's showing only, I think it's showing, I think I need to share the entire screen. Okay, just a second. Let me share the entire screen and see. All right. So yeah, it's showing everything now. So on the entire side of the other screen, on the right hand side of the screen rather, there is a trading plan. Okay, right? More like the playbook, the step-by-step guide that will basically help us to want to take the trades. So the trading plan is very simple. First, it starts with the risk management, that you shouldn't risk more than 1% of your capital per trade. Okay, no trade, no matter how beautiful it looks, is 100% certain. All right, no matter, even if it fills all the criteria, it is still not 100% certain. So you should not bet a lot of your money or more than 1% or 2% of your capital on it. And yeah, there are these guys that trade, they say they trade proprietary firms, proprietary trading on stuff like that. All right. Just a little advice from my end. All right. Do not risk more than 0.5% per trade on if you're trading a proprietary account or an account given to you by someone. Okay. Do not trade more than 0.5% per trade. All right. So let's quickly go ahead. Okay. So 1% capital, you can move your stop loss to break even when the trade is able to achieve at least 1:2 risk to reward. Okay. Now, the points of interest again, I will reiterate, are the major swing highs and lows, other blocks. When we talk about other blocks, we're talking about the breakout mitigation, other blocks, the imbalances. Also, when we talk about imbalances, the fair value gap or inverse fair value gap, the Quasimodo levels, and much more like that. So those are the things that we will be looking out for. Okay, those are the things that we would be looking out for. Okay, now the framework, which is going to be the framework, and the entry is going to be what will help us. Okay, so first and foremost, on the 4 hourly time frame, we'll try to identify the overall bias and locate major swing points. So we're looking at Eurocard now. On Eurocard, looking at it, what do you think is the order flow on Eurocard? All right, just let me know if you can see it. What is the order flow on Eurocard? Let me know in the comment section if you can see the order flow and what you think. Okay, and what you think. What's the order flow on Eurocard? What's the structure you see on Eurocard? So if you look at it on the 4 hourly time frame and you're not able to identify the structure you see, then it simply means that you are not even good to trade it. Okay, do not trade it. All right. So yes, number one, everybody have said that on the higher time frame, what we see, the order flow is a bullish order flow. Okay, a bullish order flow, making sense. So I'm in support of you. So let's stick that we've seen the bullish order flow. We've been able to identify the overall bias. Okay, and then we are also able to identify some major swing points. Okay, so let me identify the major swing points. So this is the major swing point. All right, this is the major swing point. All right, apparently it is looking like for some people they might want to say that, oh look, liquidity was purged here. But let me ask, in this case, was liquidity purged or not? In this case here, can we call this a liquidity that was purged? Yes or no? Let me know in the comment section. Can we call this a liquidity that was purged? Okay. Harrison is saying yes. Okay. So everybody's saying yes except for one person who have said no. Okay. Olawale. So, Miss Olawale, why do you say liquidity was not purged at that point? Let me know. Why do you say liquidity was not purged at that point? Okay, let me just give you still a few more seconds. Something like retracement. Oh, okay. So let me just quickly go over now so that we don't get to spend too much of time. So yes, for sometimes as well, I can find this as a liquidity purge, especially in the fact that if eventually there is going to be a change in market structure, that is prices coming back below, okay? That is prices coming back below. I'm coming. Oh, where is this? Where is this? Where is this? Where is this? Right? Especially that we would most likely see if prices comes back below this level. Come in, let me put up my anecdotes, okay? Good. So I can consider this as a sweep of liquidity if especially I find out that prices comes back below, causes a shift in market structure, then goes back to our reference point, and then we can tag along all the way to the liquidity magnet here. Can you see there is an imbalance here, and then there is an order block here. So this will most likely drive prices to come into that zone, okay? This will most likely draw prices to come into that zone. So what I would be looking out for is that, okay, look, there is a significant imbalance here that has been created. So market will most likely want to come and fill up this order. So this whole zone, the order block and the imbalance here can be more like a liquidity magnet, okay, that will attract prices into that zone. So but then I am not so certain. I can't just take trades anywhere around here, okay? I can't just take trades anywhere around that zone. So basically, I would be waiting patiently for me to see. Remember what I am looking for. Remember what I am looking for. I am looking for an impulsive move, all right, to cause a I'm looking for first a sweep in liquidity, a proper sweep in liquidity, all right, and then after that proper sweep in liquidity, I'm looking for then impulsive move to cause a change in market structure, a retracement to drive us into the point of interest, and then from that point of interest to find confirmation and tag along. Okay, don't forget that's the reversal model. It happens both on higher time frame. It happens both for bullish and bearish. On bearish, I'm looking for, this is the liquidity, I'm looking for price to sweep liquidity, and then the impulsive move to cause market shift in market structure, a corrective move to drive us to the point of interest, then we can tag along and then go ahead. All right, so this kind of W pattern, all right, is what I'm looking for. On bullish reversing to bearish, I'm also looking for the M pattern, sweep liquidity, drive into point of interest, and then come back. Okay, you can see that it's in both ways a more like a W and M pattern. Okay, so W and M pattern, I'm just saying that because for some people this can help you easily remember. Okay, so now let's quickly go ahead. So let me see what happens. Okay, let me see what happens. So let's just quickly see what happens. Amazing. So can you see that if we had considered here a sweeping liquidity, we are not so right. Right? If we had considered here a sweep of liquidity, we're not so right. But sweep of liquidity is not the main thing. It's shift in market dynamics or shift in market structure that is the main thing. All right. So we're still on the first one, trying to locate the major point of interest. So it simply means that our focus will shift from that point to this point. Could this be? Could this be the liquidity sweep that we're expecting? Let's quickly just see that. So that liquidity had been swept. So if that liquidity had been swept for a shift in market structure, we will be looking at this zone most likely, yes. So this is a shift in market structure. Then we will, sorry, this is the sweep of liquidity. Then this zone here is where we will be expecting the market structure dynamics to change. Okay, so if the market structure dynamics change, then we will now look for what, a retracement into the zone, and then we find confirmation and we take our trade. Okay, so let's still go ahead to see what happens. Good. So can you see truly this place here had been changed, because all along price had been creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Can you see? And then another higher high, higher low. It created another high. Okay, it created another high, sweeping liquidity here. Okay, it created another high, sweeping liquidity at this zone here. And then the most important thing that we want to see is that it doesn't create another higher low. Let it create a lower low so that we will be sure that, look, this market is ready to change its structure. So now that we've seen an impulsive move, can you see the impulsive move? This impulsive move is much, right? Because of course we see imbalances. Look at imbalances here. Look at imbalances here. All right. So what are we going to do? We are going to now find our point of interest. Remember, the point of interest, I have said that we can use what? The order block. We can use the fair value gaps. We can use so first and foremost, let me mark the first one. All right, we've been able to locate major swing points. All right, and then when prices enters a point of interest, we drop down to the 1 hour or the 15 minutes time frame. So first is the next step is finding the point of interest. Okay, the next step is finding the point of interest. And so in finding that point of interest, okay, in finding that point of interest, I'm coming. In finding that point of interest, sorry, I'm coming. So in finding that point of interest, we would find here that there is what? There's a fair value gap there. So anything that we can find, all right? Anything that we can find, we will just take note of it, okay? Anything at all that we can find, we will just take note of it. So there is what? A fair value gap there. And then also there is a fair value gap here as well, okay? There is a fair value gap here as well, okay? And don't forget that as well there is, okay, don't forget as well that there is this other block here, which is the last bullish candle before the bearish movement began. Okay, so there is this large other block here. There's an imbalance inside of it. There's also an imbalance here. So once prices get into any of these zones, what I'm going to do is I will step down to the lower time frame and I'll try to find confirmation. And I told you that for the purpose of learning in this class, I will be using what? The CCI. Okay, so let's simply see if prices eventually get into that zone. All right, so you see price has gotten into this zone here. All right, but it seems like this zone has been violated. So what I would do is step down to the lower time frame. Okay, price has gotten into the first zone, but there is no confirmation. Look at it on the 1 hourly time frame. So for those of you that might be wondering how I use CCI, there is another video that has been made for the CCI, the use of the CCI, and I'm going to post that video. I'm going to tag that video by the end of this class. You can find the video on the YouTube channel, okay, and you can watch. So on the CCI, there is no confirmation on the 1 hourly time frame. So remember, prices have come into one of our point of interest. So we step down to the 1 hourly time frame. On the 1 hourly time frame is where we will be looking for confirmation. Except we find confirmation, we will not enter for a sell. So yes, sell is valid, but we're not entering until we see confirmation. And on the 1 hourly time frame, you can see that there is no confirmation. So most likely the bulls might still be able to drive prices into this next point of interest, right? Let's see for ourselves. Okay. All right. So now there is a confirmation. Okay. So now there is a confirmation. So on the 1 hourly time frame, if there is a confirmation, as you've seen that the bulls have shown exhaustion and then the bears are taking over, the next thing I would now most likely want to do is to plan out my trade. Okay. To plan out my trade. Okay. So just give me a second and let me see. All right, so we have confirmation here now. I'm going to have my stop loss a little above this high here. All right, I'm going to have my stop loss a little above that high here. And don't forget, we have a liquidity magnet that I've already spotted on the lower time frame. So I'm going to be having that drag down all the way to that level. This presents us with about 1:3. All right, but we will be looking at it. Most likely what me I would love to do is knowing that there is another point of interest up above there, because I would have loved to enter at the point of interest that is at the extreme leg of that impulsive move that caused the shift in market structure, which is most likely the zone. Okay, but so I'm going to be trading carefully since it's not at the extreme zone. All right, so let's quickly go ahead. Let's see. Okay, now, you can see what has happened here. What has happened basically is that price has refused to sell, but then the confirmation that we had earlier had gone off again. All right. So most likely what I will just do is I will just close out this trade. Okay. For me, I will just close out this trade and probably expect prices to come into the next to the next point of interest. And most likely that would be what might happen. Okay. Now you can see that okay, let me see that. You can see that if we had still kept this trade, okay, because we were scared basically for prices not to stop us out on the other hand. So you can see that most likely prices went, okay. Let's see how this plays out. Let's see how this plays out. Okay, we're just waiting patiently. Let's see how this plays out. All right, so it almost stopped us out but did not. Almost stopped us out but did not. But another thing of concern is that price came into this other block here. Can you see? And after this other block, watch it carefully. Watch it carefully. Price came into this other block, which is our other reference point at the extreme. Remember what I said? And then what happened? We had another confirmation on the CCI. All right, prices trade from above the 100 level CCI level to below. So somewhere around here where we had that confirmation happen on this candle here, most likely I'm going to enter just another trade, okay, at this level here. And this time around I can have my stop loss above that reference point, and of course I'll be targeting the same liquidity magnet that we find down. Most times if you want to take 1:3, it is fine, but of course if you find a liquidity magnet somewhere ahead, then it makes more sense as well. So let's see how this plays out then. All right. So this is currently a live market. Okay. This is currently a live market, and I shared that with you on the Telegram channel of this particular trade setup. You can see that already. It is playing out really fine. Okay. The trade is still valid for a sell, and we're expecting this liquidity magnet to be reached. So this is currently a live market. But now let me show you another example. All right, let me show you another example. Let me see if I can show you another example. Still on the reversal model. Now, why is this a reversal model? This is a reversal model because price is no longer in a bullish order flow. All right, there had been a shift in market structure, and then prices were driven into made an corrective move into our impulsive into our for our hourly point of interest. From there we find confirmations, and then price is going back below. So we're expecting that price is going to come all the way down to this liquidity magnet at least for a final take profit. Okay, so let me show you another model. So first, this is also another bullish one. I don't know why I'm just making all my examples with bullish models. Okay, so this is another bullish. Okay, so this is another bullish order flow, right? So in a bullish order flow we will be buy optimistic. Okay, we'll be looking out for buy opportunities, but because of the sake of this class that I want to show you how the reversal models should work. Okay, how the reversal models should work. All right, we will be looking at this zone. Now first again, let me ask, if we want to consider this level that liquidity was swept here, can we say we're right or we're wrong? All right, can we say we're right or we're wrong if liquidity was swept here? All right, so whether liquidity is purged at a zone, it is not as important as the shift in market structure that we should be looking out for. All right, the shift in market structure is the most important thing for us. Okay, the shift in market structure should be the most important thing for us. So this can just be not a may probably not be a liquidity sweep, but just a break of structure, because market is trying to create an higher high. Okay, so in either cases, the shift in market structure is the most important for us. Okay, so let's see how this now plays out. All right, great. So you can watch here closely that we would no longer consider this zone for a liquidity sweep. There had been another break of structure here, right? There had been another break of structure here. That can be the liquidity that we're looking at to be taken out. But if we're considering that level, it simply means for a shift in market structure, we probably may want to see this level being effectively cleared out. Okay, this is the shift in market structure that we will probably be looking out for, since there had been a because if the market is willing to do, okay, let's say, let's mark out these two zones because they might be very important. Okay, let's mark out these two zones because they might be very, very important to us. Okay, good. So if we have seen a break of structure and then the market is no longer willing to continue going bullish but now bearish, it should be able to shift this market structure or shift this market structure below. Okay, so let's see what then happens. Okay, so you can see that there had been a market structure shift here, which is very important. So we're going to take that out. And this other major market swing here, can you see this other major market swing here? The market has also been able to close below it. Amazing. So we've seen an impulsive move. All right, we've seen an impulsive move that caused a shift in market structure. The next is a corrective move that should take us into a point of interest. All right, and what could be those points of interest? First and foremost, yeah, I would now begin to map out my points of interest. Here I have seen here I have seen another block, and this other block costs this large market movement. So most likely I should be expecting that prices should come into that other block. Okay, I have also seen a fair value gap all the way down here, but I will not want to consider that level as much. But most importantly, let's see how prices play out, and let's see when the retracement begin. In the worst case scenario, we can use the Fibonacci tool to find the level of retracement. Okay, so let's see how prices play out and when the reversal happens. Okay, so you can see that prices had come into this 4 hourly point of interest, and of course there was a reversal here. So let's see the Fibonacci retracement tool, what it tells us. Okay, so if we're using a Fibonacci retracement tool all the way down to this point, for me and for most of you that know that okay, sorry. Okay. Yep. So for most of you that know, you know that if I want to consider my Fibonacci retracement level, I like to consider between 65%, all right, that's 61.8% to the 75% level, which is this level here. All right. So Fibonacci is telling us that our discount level will be up above here. So now that price is in this level, what should we do? Scale down to the 1 hourly time frame. Okay, so I scale down to the 1 hourly time frame. Remember, now I'll be considering sell because simply because there is a shift in market structure. If this shift in market structure did not happen, I would most likely not be considering a sell. All right, but this shift in market structure tells me that sellers are willing to now continue to push prices below. Okay, so now watch closely. On the 1 hourly time frame, there is a confirmation on this candle here. All right, it was at this candle that the commodity channel index moved from above the positive 100 to below. All right, so what I would simply do is this. All right, I'm going to place a short position by this next candle opening. I'll have my stop loss a little above, okay, so that I would be clear and void of eating out on stop loss. All right, having my stop loss well above this level would have been good, but that would mean that I'm risking so much, about 224 points, okay, or pips rather. So I'm going to keep things close and simple, just a little below this level. And if the risk to reward is not great, then I'm also not going to consider it. All right. So most times we will most likely have prices come back into this level. All right. But that's a 1 is to 1.8 risk to reward, and that might not be so great. So what do? We're going to look out for the other levels that most likely prices could come back into. There's an other block here. I find another block here, which most likely prices can come into. Can you see this other block here? All right. So most likely prices can come into that level. So this creates a 1 is to 4. All right. So let's go back and see if this plays out. All right. Remember, you can always partial close, or move your stop loss, trade your stop loss to break even if the trade setups achieve 1 is to 2 risk to reward. Okay, so I'm doing making the confirmations. Okay, so yeah, wait for price to confirm using extra confluence techniques, which I have done using my CCI. Then enter the trade after confirmation. So I have entered the trade after the confirmations. Okay, the entry techniques is our price is fully driven into the 4 hourly point of interest. Yes, this was our 4 hourly point of interest. Then there is a clear imbalance and shift in market structure on the lower time frame that we might not be able to that I may not be able to show you in this video. But then the CCI confirms entry on the 1 hourly time frame. Yes, the CCI confirms entry on the 1 hourly time frame. All right, so let's quickly just see what happens next. So in the worst case scenario, we're expecting prices to come down and most likely break below this level. Mm. So I'm not going to change anything. I'll just leave it that way. All right. And then we see how prices flow. Okay. So we got stopped out on our stop loss. We got stopped out on our stop loss, but I'll still leave it. All right. I'll still leave it. So we can just see finally how prices play out. All right. So it was me who made the bad decision in choosing the 4 hourly point of interest. All the setups are good. I just wanted you to see this now. All the setups are good, but we made the bad decision on choosing the 4 hourly point of interest. So I'm going to take this off now. So most times, the best 4 hourly point of interest that we should find or would find is the one at the extreme. Okay, so let me go by the Quasimodo. Okay, if I want to go by the Quasimodo, I'm then going to consider this whole entire swing eye and what costs this sweep of liquidity. And of course, if I'm going to be considering that, the Quasimodo level will want me to consider this whole level here. Okay, this whole other block that was formed last before the sweep in market structure. So most times also the Quasimodo is really good. Okay, the Quasimodo is really good, but sometimes I just forget how to use it. Okay, so if we're to use that now, if we are to use that Quasimodo, we would most likely have our trade setups here when we had confirmation here. Okay, and have our stop loss a little above this liquidity level, and of course drag it all the way down to this level here, still creating about 1 is to 5 risk to reward. Okay, still creating about 1 is to 5 risk to reward. So we were able to eat that if we had used the Quasimodo level. And that's why I said for you, you might want to go over and check which works for you. Most times I use a Quasimodo level, I use a retracement level, and much more. Okay, so this is for the reversal. Let's quickly go over to the continuation.
Sorry, sir. Please, what's a Quasimodo level?
Quasimodo, Quasimodo basically is Quasimodo levels basically talks about psychological levels where prices could come and have it sounds like more like a supply and a demand zone. Okay, sounds more like a supply and a demand zone. Okay, can I continue now? Can I continue now? All right, silence then. It simply means I can continue. All right. So amazing. So let's quickly talk about the continuation. So I'm going to be using gold on this. All right. So the other flow we can find on gold here is a bullish. Okay. So it simply means that we would still be expecting some more bullish movements to happen. But then there had been a significant bullish rally. All right. So even though this is to continue bullish, we need to expect that prices will come into some significant levels. So what are those levels that we might want to look out for? Okay, we might want to look at um we might want to look at the um sorry, I'm coming. Okay, so we might want to look at a mitigation level or other block or fair value gap as the case would be. Okay, but in either cases I would also be watching the momentum so that I don't get to make mistake. I'll be watching the momentum on the 4 hourly time frame. All right, so what are those levels? This is a mitigation area. Okay. Mm. So this is a mitigation block. All right, a mitigation block is a block that was supposed to be respected the last bullish candle before the bearish movement, but now prices traded above it. Okay, so it's a mitigation block. Okay, so that's going to serve as one of our 4 hourly reference points. Okay, it's going to serve as one of our 4 hourly reference points. I'm also going to try to use the Fibonacci retracement tool. Okay, so take my movement from here up to this level. I want to see prices come into the 61.8 to the 75% level, of which our mitigation block is already lying around that 61.8 to the 75% level. Right, aside those two areas, aside that two confluences, are there any other one that we will probably want to be looking at? um Okay, there is a little imbalance here, but nothing of significance to pay so much attention to, except we want to look at this fair value gap that is here. Okay, let's just mark it and see. All right, so now for me not to make another mistake, all right, I will not just rely that price will come into this zone. I will also be watching the momentum as it plays out on the 4 hourly time frame so that I can take more accurate trade. Okay, so let's see what happens. The momentum is very, very important to me. Okay. Okay. So we're not flinching. We would wait. We would wait because prices had not entered into our point of interest. Okay. So if prices doesn't enter our point of interest, then we leave it. Okay, good. So prices has entered into our point of interest. Can you see that now? So yeah, it took longer time. It took longer time, but it is good that we wait patiently for prices to enter into our point of interest so that we don't get to activate unnecessary trades. All setups are good, but because we made the wrong decision like the first time, then we got stopped out. Can you see that now? So now that prices has entered into the 4 hourly point of interest, why I said I'm going to watch the momentum is because on the 4 hourly time frame, we can also see that the momentum is super bearish, but the bears are about to relinquish their powers. Okay, so the bears are already showing that their dominance is simply getting over, and it's already on that mitigation block zone. So I'll just scale down to the 1 hourly time frame. Okay, I'll just scale down to the 1 hourly time frame, and on the 1 hourly time frame, I want to see the commodity channel index. Okay, give me some confluence or confirmations. All right, so number one is that we were able to determine the structure and then find the point of interest on the 4 hourly time frame. Number two, we're able to scale down to the lower time frame 1 hour and find that price came into this zone significantly. And then number three, we're now going to wait patiently for a confirmation on the 1 hourly time frame, of which the confirmation came somewhere around this level here. All right, you can see confirmation came on this zone here. All right, on this candle here, you can see that the 1 hourly time frame already, the CCI has confirmed that the bulls are now dominating that market. So what I would simply do is to take a long position by the next candle opening. My stop loss is going to be below this level. All right, and then of course I will look for any liquidity magnets that I can find on the 4 hourly time frame. Okay, I'm going to look for any liquidity magnet that I can find on the 4 hourly time frame. Yeah, there is a significant imbalance here. Okay, can you see that? Let me zoom in so you can see. All right, on this zone here, there's a significant imbalance there. So I would probably be expecting that prices would most likely move into that level. Okay, so let me just see what happens here. Let's go back to the 1 hourly time frame and let's see. Right, so that we don't get to make mistake next. Okay, on this one, so this is giving us 1:3 risks to reward, which is a good one if we eventually get to eat 1:3. Right, so let's see how this plays out. All right. So it's still in our favor. We're still in game. All right. We're still in the game. But if you look closely, you can see that, okay, prices is really going to go bullish. Why? Because we can see that on this zone here, there had been a change in market structure. Okay. There was a bearish structure coming all the way down here. So there had been a change in market structure. We also see that prices came back into this fair value gap. Can you see that? Prices came back into this fair value gap, activated, and then it's going back up again. So for some people who have the eyes, okay, and can wait patiently, some people might want to say, okay, look, because prices came back into this fair value gap, and then I see confirmation here, right? So there's a confirmation somewhere around here. I might take a second trade, backing this up, and go all the way up. This one now, my stop loss can be just below this level here. So this gives us 1:2. Okay, so let's still see how this plays out. And then voila, we're able to eat our 1:3 risks to reward. Okay, we're able to eat our 1:3 risks to reward. So we can do this for continuation patterns. All right, continuation patterns where we can see that, okay, the bullish order flow could be bullish, all right, or bearish. Then on the 4 hourly time frame, we find a significant level, so long as it does not cause a major shift in market structure. When prices come into that level, we can find confirmations on the lower time frame, and then we can take our trades. All right, just one more example. All right, one more example and we will go. This is a live market. This is a live and current market. Okay, this is a live and current market, so there's nothing like replay on this one. All right, and it is euro AUD. It is euro AUD. Now on the euro AUD, what is the structure that you can see? Okay, I want everybody to look at it. This is a live market that is currently ongoing at the moment. What can you see? What can you see? What is the order flow that you can see? What's the order flow that you can see? Let me see. All right, nobody's saying anything. Uptrend. Okay, amazing. Mr. Harrison, you're welcome. So what's the other flow? What's the other flow on the 4 hourly time frame that we can find? Bullish, right? Now, this is a bullish order flow. And of course, I've been able to also map out a trend line channel. But forget the trend line channel, okay? Forget the trend line channel. All right, let's quickly just take a look at this. If this is a bullish order flow, all right, and then I am looking at this, I said, okay, look, this market is making some significant movements, okay? This market is making some significant, sorry, this market is making some significant movements. I don't know where, sorry guys. Mm. All right, so this market is making some significant move. I'm going to be marking out only the significant levels. Okay, so this is equal low. and then here, again here, here. Okay, so we can most likely say that the next move will be bullish. Okay, why? Because if you look at it, the market has not changed anything. Okay, the market has not changed in its structure. The market has not changed in its structure. If you look at it, this is a bullish movement creating higher lows. Okay, another higher high, higher lows, right? Another higher high, and then again what? An higher low, higher than this previous one. This is a minor low, minor high low, but it's still higher. So that's why we don't consider this in this whole setup. So in this case here, we have price on the 4 hourly time frame coming to our point of interest. Now it will be our duty to watch the momentum on the 4 hourly time frame, and the momentum is super bearish, but it looks as though that the bears are about to give off their dominance. Can you see that on with the CCI? So the best thing will be we scale down to the 4 hourly time frame. All right, and if we scale down to the 4 hourly time frame, we want to find confirmation on this zone. Okay, we want to find confirmation on this zone. So confirmation on this zone can come in various ways. On the 4 hour, on the 1 hourly time frame, already there had been some bullish confirmations. Come in, let me move this up. On the 1 hourly time frame, there had been some bullish confirmations already around this area here, but the market had been, choppy, and sometimes yes, this can happen. So what I am basically waiting for is for me to get another bullish confirmation on the 1 hourly time frame. Okay, I want to see another bullish confirmation on that 1 hourly time frame, and with that, I want to see that the CCI comes back below, comes back to the negative 100 level. Okay, the negative 100 level, and plays back above, and then I can take a buy position. And if I take a buy position, hopefully it's going to be a very profitable trade. Why? Because I've already begun to spot that here we have an order block and we have large imbalances that needs to be filled. Also above here, we have an order block and we have large imbalances that needs to be filled. And so with this in mind, taking a buy trade at this zone here would most likely pose to us as a profitable trade only when we find confirmations on the 1 hourly time frame. Okay, so we can probably be looking at this order block here, and this will give us 1:5. Or in the worst case scenario, we can be looking at this other block here, prices coming back to this other block, and this can give us about 1:4 risk to reward. Okay, so I decided to use a live trade also, so that you know that this can work not only on replay but also on live. So the last but not the least before we go, guys, just very quickly, the last but not the least before we go, okay, the last but not the least before we go, all right, so just pardon me. Let's quickly take a look at this. All right, so this can work basically not only for currency pairs or commodities and so much more like that. It can work both for stocks. If you understand the concept, you can apply it for stock. You can apply it for any other ones. Okay, energies, shares, and so much more like that. So here on this case here, we have prices was bearish. Okay, let me first of all go into that detail. Okay. Okay. So prices was super bearish. This is US oil. Prices was super bearish, and then eventually prices came into this level here. So first and foremost, prices came into this level. We would have most likely, all right, we would have most likely said that this is a liquidity purge, and then we were expecting, okay, the shift in market structure, which is the most important thing, all right, it should be caused by an impulsive move, and this never happened. Okay, even here it wasn't, this is not a proper shift in market structure, so we don't even consider that. Okay, and then again we now begin to find that prices came back and into this zone, all right, so therefore causing a shift in market structure, okay, sorry, causing a liquidity purge. Prices went down to make an equal low with this. Equal low simply means that prices is not willing to go lower. All right, the bears do not have the power to continue pushing prices even lower. All right, so now that we've seen this liquidity purge, like I said to you, the most important thing me I always look out for is the shift in market structure. All right, once I don't get that shift in market structure, even if I see a liquidity purge, it doesn't make so much sense to me. The most important thing that I want to see is shift in market structure. All right, so there is this shift in market structure that I was expecting that would most likely happen. All right, but it never happened. Okay, this is not a shift in market structure. It never really happened. So let's see what happens. I wanted to demonstrate something here to us. Okay, good. So yeah, amazing. So here now we see this shift in market structure happen properly. Okay, we see that shift in market structure happen properly. So for me, I would most likely be looking for the reversal points. I can use my Fibonacci retracement levels, or I can find any point of interest on these 4 hourly zones. Okay, now that we have shift in market structure, I know that this market wants to go bullish. All right, so but then I need to find the zone to enter this market. Okay, so let me allow it to finish the impulsive move. Okay, good. All right. So in this case here now, we've seen that shift in market structure, and then we've seen that prices basically is coming back. So Fibonacci retracement tool will most likely want to help us. All right, take from here up to this level, and we may want to see that prices should come into the 51% to 75% level. All right, that's going to be our significant zone there. All right, and then of course I'm going to put up my momentum indicators, okay, which is the CCI, to also monitor the momentum to see what happens. So this is our Fibonacci level. Okay, so I'm going to put that as our Fibonacci. Okay, this is going to be our Fibonacci level. All right, what other thing can I find, guys? If you see anything, let me know. Right, this is going to be our Fibonacci level, and of course our Fibonacci level also takes into cognizance this particular order block that is here. All right, so well above that Fibonacci level also we can find some little fair value gap. Okay, we can find some little fair value gap. So in either case, is either it comes into our Fibonacci level, which also have our order block, or prices should come into our fair value gap. Okay, our fair value gap. Sorry, our fair value gap. Okay, good. So let's see what happens. Except prices comes into these levels, I am not willing to take any trade. Okay, except if prices, if we're missing it, then it's good we miss it. All right. So price actually came here. Let's see. Did it get to? No, it did not get to. So most times it's better we miss prices. We miss the move than we miss our money. Okay. So let's still see. I wanted to show you guys something here. All right, so this becomes invalidated for me. Okay, because why? Prices did not come into my Fibonacci level, neither did it come into the fair value gap. All right, instead prices went into our mitigation block that we did not spot. All right, this was our mitigation block that we did not spot. And let me show you that this worked. So this was our mitigation block. Can you see that? So that's why I said fair value gap, Fibonacci, mitigation block. Because most times the mentors that we follow on YouTube or any other places, they might not tell you. They will just say this is how to use fair value gap. And then they will go and bring just 1 or 2 instances where fair value gap work. And when you go to practice it, you now find out that in most cases it does not work. So what I try to do is I try to use every of those concepts that prices come into them. I try to find confirmation. Okay, that prices come into them. The next thing is I find confirmation. Okay, so look, take this off. So now let's look at this. This was the mitigation block. All right, there was a mitigation block here, and then the fair value gap, and then the Fibonacci tool. Okay, so when prices came into this zone, can you see that the bears that the confirmation tool also told us that the bears are not willing to continue pushing prices lower. So on this level, we would have scaled down to the 1 hourly time frame and find a perfect entry into that market. But we missed it because we were not able to find that mitigation block. Okay, so look at this. Prices actually confirmed on the 1 hourly time frame on this candle here. Can you see that? So if prices confirmed on this candle here, we should have been able to enter the market by this next candle opening. Our stop loss will be below that mitigation block. And of course, we will go over to the 4 hourly time frame, and then we will be able to find, okay, we should be able to find anything that makes sense to us. Like there is an imbalance here, then there is this other block here. So of course, I will be expecting that prices should push up to this level, or even this reference point here. All right, and that gives us 1:3.5. All right, so we would have been able to take this trade if and only if we were able to see that mitigation block. Okay, so this brings me to the end of my class. All right, basically, let's do a quick recap. I know it's a very long one. Find the market structure and order flow. Okay, the next is the liquidity concepts we should not forget. And then number two, the points of interest, which is the most important one to us. Order block, imbalances, breaker block, mitigation zones, or Quasimodo levels. Now, guys, that's where the bulk of the work will be. So if you want to become really good at trading, go over to find, because identifying market structure and order flow is quite easy. Identifying liquidity is quite easy. But the bulk of the work, I'm telling you, the bulk of the work where you have to find the point of interest, that's the bulk of the work. So go and study other blocks, study imbalances, breaker blocks, mitigation zones, Quasimodo levels, and then attached to it will be momentum on the 4 hourly time frame, because that's what is going to tell you the validity of those points of interest. Okay, so and then once you get that, step down to the lower time frame, find extra confluences, and you will be good. Okay, so thank you so much, guys. If you have any question for me, I think this will be the best time we take